Welcome to Element Portfolio. My name is Marcus and this is my portfolio. And today we're going to talk about the markets. So this is the first update, just to give you some brief background. This is the first time I do this in video format. I usually write a Sunday market update each Sunday where I go through the different markets. As you can see here, we have a summary, past week news, the sentiment, market update, where I walk through the indices, US sectors and industries, rates, foreign exchange, commodities, then a summary and news for next week. So let's dive right in. So if we look at the past week news, we got some economic indicators. So first we had the leading indicator that fell more than expected, also GDP. So we see here for the US, we have the result of 2.1 for 2022, 2.1%, and that's not as big a growth as for 2021, which was 5.9%. And then we can see we got PMI for service, and that was 46.60, which is a little bit more than previous, but it's still below 50. And we can see this is the same pattern for all the rest. For manufacturing, it's also a little bit more than previous one. And composite, also a little bit more, but still below 50, which is a recession indicator. And then we got home builders, which is higher than expected, but it is also lower than previous, which is not good. And then we have the PCE deflator, which came in as expected at 4.4. And this one is also lower than the previous, as 4.7. And then we have the PMI for the euro area, which is around 50. It's also a little bit higher. And then we have manufacturing, that's a little bit higher, in composite. It's also a little bit higher, and some of them are above 50, which is good. Only though we'll see if it's temporary. And then also the consumer confidence is a little bit higher, but still negative, and it's 20.9, and previous was 22. And the UK also had the PMI report, so service was lower than expected. Manufacturing was a little bit higher, and composite was a little bit lower, so some mixed signals. So if we look at the market sentiment, we can see here that 2023 has really had a strong start. And we can see it across all the major indices that have rallied more or less since October. We had a little bit of a slowdown of a rally in December, but then after New Year, it just kept on going up. And if we look at fear and greed, we can see that it's higher than last week, so it is stretching up in this zone here. And we can see a slight divergence here, because even though this one is going up, we also see that the net long position is going down. That means that more retail traders are putting on short positions or selling off compared to last week. And in the same area, we actually see that more people are going short USD or long the euro in the pair, and we also see a slight difference in gold when it comes to the net long position. So a little bit mixed here, and I think what we should look at is that the sentiment it's getting into that high territory where we should expect that it's stretched on the upside more or less. But we'll see. There are some mixed signals out there. That's why I call it this update, the battle between the FOMO bulls versus the bears. So we have many people that have seen this rally just keep going up since October, and everyone's been expecting the market to fall, me included, but it just kept on going up. And now we can actually see more and more of the FOMO traders coming in that are expecting that we should deliver new all-time highs. And then we have the other camp that think that this is just a bear market rally, and that a healthy market should decrease to new lows due to the economic climate. Like we saw in the economic indicators, PMI, for example, that's very reliable, that we are heading for a recession. But we'll see. That is the interesting part right now. We are in that kind of either or, and the market can still continue to go. Since it's going so strong, it can still continue to do that for a while. So we'll just have to see. If you look at indices now, for example, we have for the year, you can see we have an average increase across all the major indices, and it's about 7.75% average up. since New Year's. But if we look at the 200 trading period look back, which I think is a little bit more reliable since we're only 1 month into the year, then we can still see like, yeah, some of the indices have caught up and we're about plus minus zero. We see the biggest losers are still S&P 500 and NASDAQ. This one a little bigger, so you can see it here. And this is for the year to date. And if you look at the volume, it still looks like it is increasing slightly, but it's still trading in this middle range, so nothing too much. We can see it here in the box plot that it is within normal levels. And also if we look at the VIX, we can see here that once again it has come down and it is well below 20. And so new lows within 200 period, and now you can see it is some kind of consolidation formation we have here. This is of course the spike in 2020, and we can see that after these long periods there is going to be a spike, which we have seen all this time. So this pattern is repeating. However, we'll see how much further into 2023 it'll go before we can see a new spike and what the catalyst is going to be. If we look at the market updates for the indices, we can see here that the thing I like to notice, like we know that all the markets, they have been going up strong, so no news there. But finally we have the S&P 500 and the NASDAQ and also the Nikkei 225 have crossed and closed above their SMA 200, their moving average 200 periods. And we can see there is some difference here. If we look at the box plots, we see that this is coming out outside the box. Here we're still in the middle of it, and compared to the rest of the indices that actually crossed the SMA 200 months ago, we can see that they are trading far out with high tail risk. Like this is in outlier country, and it is if we think about mean reversion theory, then there is gravity towards the mean here. So we'll see how it goes. If we zoom out, yeah, this is the year to date, everything's going up. And then if we look 10 years, we see that different patterns. This one's still coming down. Here we see a big increase for many of the European indices that are going closer to all-time high, which is, I don't know if it is ridiculous. To me it feels ridiculous. And we also see that it is stretched out up here. And my opinion is that the market should go down more and should come down to lows. And I would say a fair point would be somewhere around the 10-year mean before the market can rebuild again. That's where I'm keeping my eyes at. I don't think that we might do new all-time high, but that would just mean that, yeah, then it's just for speculation. Then it's not about the economy anymore. But if it goes down towards the mean, like this is a bear market rally, and then it comes down, then I think we should see new lows around their old 10-year mean. But we'll see. If we continue to, yes, that's something I can mention as well. Like a side project besides from this is that I put together a portfolio analysis based on these different indices. So I'm making the classic modern portfolio theory about the efficient frontier, most efficient portfolio, minimum variance, etc. So I put together a data analysis project around this where I used all of these different indices that I just talked about and what the perfect allocation would be, depending on if you want to decrease the volatility or if you want to maximize the Sharpe ratio, which is the risk to reward ratio. So you get as much reward possible for each unit of risk. So check this one out. There's going to be a few more updates for the other assets that I have in my Sunday market update, and then later I'm going to incorporate it with my Sunday market update. if we continue here to the sectors, this one is a pretty far one, so I'm going to scroll down to the bar chart. And here we can see year to date, we can see that it's pretty wide. Like the increase now for the S&P 500 in the US, it is wide across most of the industries, with only consumer staples and healthcare and utilities that are negative. But if we compare that to the 200-year look back, then we can see that it's a little bit more different. And still some of the winning are for example, the energy, which is no surprise given the situation. And we also have one of the winners as solar, then biotech, and then home builders and industrials. And what I think, if we're going to look into 2023, that I think some of the sectors that's worth taking a look at is consumer staples. So if we look here, so in this, if we're going in towards a recession, then consumer staple is going to be stable. And it is still going to generate slow and steady profits. And I think this is a good bet if you want to take down the volatility of your portfolio and maintain your portfolio. So see here, this trend just keeps going, and it is weathering out most of the climates. So low volatility and just stable. And I also think two other, energy of course is going to be a winning sector. If we look at, yes, now it looks very stretched on the upside. But right now China, they have their Chinese New Year's and they're about to open up, and they've opened up more, and they have been documentations about increase in traveling for Chinese and increase in the industries as well. And this is all very energy intensive. So we cannot forget that oil is included in here. So even though we might head in for a recession, we still have to keep the industries going. And then the ones that have to pay, they are going to pay for oil. Or any kind of energy they need to get the industries going. So even though the inflation is going high and maybe there's a low supply at the moment, the demand still have to pay the price. So I think that's a good one, but it looks very stretched here. I would be careful though, but I think some kind of exposure towards energy sector would be good. And financial sector might also be really good. Now when interest rates are going up, like this is the sector that profits from it. And if we look towards what happened in like our past recession, the big recession was, or the Great Recession was focused on financial banks. Like that was the major sector that went down. But they have prepared for this since then. So they are well capitalized and they are prepared. So they shouldn't be, I think that's also a safe bet. Like now when a lot of things have gone down, like this is the sector that is going to profit from increase in rates. But we'll see. And here we can see also update for the rates. We can see they have kind of consolidated here all across. We have the FOMC's rate decision is this week. So I think that'll stir some things up. So we'll see what they have to say now after Christmas and New Year's and what the lookout is for 2023. So for now I'm going to leave this one and wait until after the meeting, and then we can take a look at it. Still see the rates have gone up a lot since 2020. Continue with foreign exchange. I think the common denominator here is that the US is depreciating towards the other trading pairs. So other trading pairs are, so here example Euro USD, you see that the Euro is gaining strength, as well as USD towards the yen, it is going down. So I think that is the big one to notice. It is about the USD. And we had, and this is the hard part, like recently, Yellen, she said that the U.S. are going to raise their debt ceilings, or they have to raise their debt ceiling, or else they're going to default on their debt. So we're kind of in a situation where either the U.S. is going to default, which is probably not going to happen, or they have to print money to meet their debt obligations, which is going to devalue the dollar. But at the same time, the USD is still the reserve currency in the world, so there is still a demand for your dollars. So it is still the flight to safety for assets. So now when markets have gone up and we have increased the risk towards more risky assets, if or when the markets are going to go down, then there is going to be a flight back towards the USD, because that is still the reserve currency. So I think what we see here, it doesn't look good for the dollar, but it's important to remember that the dollar, or foreign exchange, it can go how far in one direction or another one, depending on what's going on in the economic environment. So even though don't analyze too much with the trends, this can very abruptly change course, depending on what the macro climate is. So what I think here is we're gonna keep seeing a decline in USD until we see a bigger decline in the markets and risky assets. And then we're going to see some form of spike or flight towards USD. And when that happens, I don't know. And we can also look at just shortly Bitcoin and Ether. I don't focus too much on crypto here, but I like to keep it as a watch as a risk sentiment. And we see here as well, it has been a big increase since New Year's or the end of December, and that's also strengthening the hypothesis about the increased risk in the markets. Finally, to end with commodities, we have all the metals: gold, copper, platinum, aluminum. All of them have been strong, and gold have really rallied now since the change since New Year's. So, and that should be due to the higher inflation and increased risk. So gold it's kind of been delayed throughout since 2020. I think most of the money went to crypto as safety, as an insurance towards inflation. But now we see some increase in gold, and we'll see how long it'll keep and what the new target rate is going to be. But I still expect sometime during 2023 we should see new highs. It's been consolidating now for a while. Maybe it's going down one more time and then up. We'll see. But I expect new highs in gold. And also we have copper, for example, that's heavy in industrials. Now when production is starting and with the reopening of China, it should also continue to go up. We have, let's go back to this view. We can see natural gas have plummeted straight down, and we'll see. It's been a mild winter here in Europe. That was the big increase for the speculation that it should be due to the war in Ukraine. But now it's been mild, which is of course decreasing the demand for gas, which is leading the price going down. So we'll see how it's going to continue, and I think it's weather dependent on what's going on here in the world. So far a mild winter, and let's hope so for the European economy. And then we have crude oil, and I think I'd like to see there's some kind of bottom here. So I think the oil could continue to go up, but we'll see. And then we have wheat that I'd like to say a few words about, and that's just I think this spring is going to be, we're going to see the effects of the war in Ukraine. So if we go to the 10-year here, let's see. Yeah, we see the big spike here that was due to this to when the war broke out, and then it's come down. And I think we're not going to see the real effects until this year's harvest, or when they're starting to plant the seeds for this year's harvest. Then we're gonna know the effects of the lack of fertilizers. How much is Ukraine going to do? How much do we have to supply extra from the rest of the world? So I think that's something to keep an eye out for during this spring. So to summarize, the markets have continued to rally, and it's become a battle between the bulls and the bears, and we'll see how long it is going to continue, and it might actually continue longer than reasonable, so we'll see. So it should be traded with caution, both on the upside and the downside. And my bet for 2023 for the strong sectors are consumer staples, or well, that's going to be a stable one to decrease volatility. And then we're going to have banks and energy as well. And rates have consolidated now for the past months, and we'll see after the FOMC rate decision. And then USD is getting weaker compared to its trading peers, so that's also going to be dependent on what's going on in the markets. Metals are going strong, natural gas is going down, and oil might have hit a bottom. Continues to move momentum, and the next week we're going to get consumer confidence for the euro area. That's on the 30th of January. We're also going to get the preliminary GDP result for euro area, and then on February 1st we have the FOMC rate decision. We get core inflation for euro, and then on the 3rd, on Friday, we have non-farm payroll, unemployment, and ISM, and then for China we're also going to get the PMI. So it's going to be an interesting week. So I hope everyone has a great Sunday and a great week. Take it easy out there, and I'll see you guys next week.